The second part of the Missing Second semester is about investing and different tools and rules for successful investing. You can compare investing to planting a tree. You can plant a seed or invest a small amount, and if you take care of it and let it grow into something much larger. Investing is an important tool for financial growth and future stability, yet 45% of Americans don't invest. This is sometimes due to fear or mistrust or even lack of understanding or education. As a high school or college student or graduate, your career and most of the money you will make is still in the future. Your young age is an asset and gives you the advantage of time to increase your investment success. This table shows the earning potential for a 22-year-old entering their first job after graduating and earning the average annual U.S. salary of $50,000. As a 22-year-old with 42 years of working ahead, you can contribute $196 every month to your retirement fund. This is the minimum required for the employer contributing 4.7% to receive the maximum match. If you contribute the minimum of $196 and receive your employer's maximum match, you will have a total of $4,700 invested per year and $197,000 over the entire career. If your fund earns an annualized rate of 6% over this time, it will grow to $850,000. Annualized return is the average return of the fund. If the fund earned 2% more, your total fund value would grow to $1,480,000. If the fund earned 10%, you could have a value of $2,650,000, making an average yearly salary with your minimum monthly contribution and employer match. There are different types of investing. Some of these are bonds or equity investments. Equity investments include stocks or ownership stakes, mutual funds, and exchange-traded funds, which are baskets of stocks. Financial professionals recommend investing in equities for the first 2 to 3 decades of your career if you start young, and switch to lower risk investments such as bonds closer to retirement. Equity has greater long-term return potential, but higher short-term risk. Some money vehicles include checking and savings accounts and certificates of deposit at banks. Checking accounts can be used to pay bills or your daily expenses. This money vehicle doesn't grow your money, but it is protected by your bank. Savings accounts pay small amounts of interest and are often used for emergency reserves. They can protect your checking account from getting too low and being charged an overdraft fee. This account is also protected by the bank. A certificate of deposit will earn you more interest, but the money you put in will be locked up for some time, and you will be charged a penalty for early withdrawal. This account is protected by the Federal Deposit Insurance Corporation, a government agency, up to $250,000 per bank. CDs can be used to save for short-term goals, such as vacations or purchases. The money will grow for the CD term and can be used after the term ends. Bonds and stocks are two investment vehicles. Bonds are loans to a company or institution for which you are paid back more than you originally invested. They have more risk than a bank account, but are still considered generally safe and pay a higher interest rate. Holding bonds for a longer period of time will increase the interest rate, but will also increase the risk of not being paid back. Loans to the U.S. government, such as Treasury bonds, are protected, but loans to corporations are not protected. Stocks are ownership stakes in companies. If you buy a stock, you have a stake in the future earnings of the company and have the opportunity to participate in its growth or the industry growth. However, stocks are not protected and you can lose the entire amount of your investment. Other investment vehicles include mutual funds and ETFs. Both of these combine stocks, bonds, or other securities into one investment. They usually charge a small annual fee and provide more diversification than buying a single stock. These funds can include many different companies from a single industry or different industries. ETFs are very similar to mutual funds, but usually charge a lower annual fee and are traded differently. ETFs are bought and sold throughout the day, while mutual funds are traded once a day after the market closes. If you don't invest, you have a 100% chance of losing money because of inflation. You lose money due to inflation because it increases the prices of goods and lowers the value of your money. Investing is the best way to hedge against inflation. Stock market indices historically outperform inflation or grow at a higher rate than inflation. The money you invest can grow faster than inflation and prices, which increases your spending power or ability to purchase goods. The S&P 500 is a stock market index made up of 500 of the largest publicly traded companies. Publicly traded companies are those that have stocks traded in the stock market. The companies in this index are based in the US, but can operate in other countries as well. The process for including companies in this index is very rigorous. Fewer than 0.009% of all U.S. businesses are included in this index. Once a company is added, it has to maintain a certain level of growth and financial stability because it can be removed. The stock market is a joining of buyers and sellers of stocks. The market has certain regulations to ensure safety and stability. Publicly traded companies are legally obligated to act in the best interest of the shareholders. Companies go public and issue stocks to raise money for operations and growth. A shareholder's risk is limited to the amount they invested in the stock. They have the right to share in earnings, but do not bear the liability if the company has debts or fails. Individual stocks and companies can fail, so funds with many different stocks minimize your risk exposure. Index investing does not guarantee to increase every year, but generally increases over time. There are 3 general principles to help you invest successfully. These are to underpromise and overdeliver, buy a little bit a lot of times, and when something valuable goes on sale, buy more of it. If you expect the market to perform at a certain level, plan for it to perform lower. If you expect market returns to be 10%, invest so that you are meeting your financial goals as if the market will only earn 6%. If you need to invest $3 daily to meet your goals, invest $5 instead. Dollar cost averaging is investing $1 every day. If you invest $1 a lot of times, you will earn a lot over time. Over a 42-year career, you would invest $15,330. Earning the average return of 10.5% would grow that daily dollar investment to $289,500. Investing regularly, even in small amounts, whether that's a percentage of your paycheck or a dollar amount from your bank account, every week or month will grow your future value. Finally, buying something at a low price can make you money once it grows and you sell it high. In 2008, the stock market dropped 38%. This does not happen often. An economic downturn can cause panic and fear, which will make investing decisions very difficult. But in this low price market, it is the best time to buy, so when the market recovers, you will be able to sell for much higher.